Out of the tree of life, I just picked me a plum. You came along and everything started into hum. Still, it's a real good bet, the best is yet to come. Best is yet to come, and babe, won't that be fine? You think you've seen the sun, but you ain't seen it shine. Wait till the warm-up's underway. Wait till our lips have met. And wait till you see that sunshine day. You ain't seen nothing yet. The best is yet to come, and babe, won't it be fine? Best is yet to come, come the day you're mine. Come the day you're mine. I'm gonna teach you to fly. We've only tasted the wine. We're gonna drain the cup dry. Wait till your charms are ripe for these arms to surround. You think you've flown before, but baby, you ain't left the ground. Wait till you're locked in my embrace. Wait till I draw you near. Wait till you see that sunshine place. Ain't nothing like it here. The best is yet to come, and babe, won't it be fine? The best is yet to come, come the day you're mine. Come the day you're mine. And you're gonna be mine.
I see them blue for me and you, and I think to myself, what a wonderful world. I see skies of blue, clouds of white, bright blessed days, dark sacred nights, and I think to myself, what a wonderful world. The colors of the rainbow, so pretty in the skies, also on the faces of people going by. I see friends shaking hands, saying, how do you do? They're really saying, I love you. I hear babies crying. I watch them grow. They'll learn much more than I'll ever know. And I think to myself, what a wonderful world. Yes, I think to myself, what a wonderful world. Oh, yeah.
Hey everyone, welcome to our final session. We have made it to the final session today of Financial Literacy Month. And we'll just do some quick introductions again. I think everybody knows who we are, but just in case not, my name is Alexandra Dowd. Will be one of your presenters today. And my other presenter is Daniel Barrett. We are excited to have you here with us. And we would also like to ask, we have a lot of information to get through today in a very short hour. So if while we're going through the presentation, if you could just write down any questions that you have, and at the end of the session, me and Daniel have put out some extra allotted time to stay after to answer anything that you might have, and we'll be happy to stay later to get all those questions answered. Okay, so without further ado, we'll go ahead and get started. Before we get going, can everybody hear me okay? I just want to make sure that the mics are good. Do I sound like I'm really far away, or everything good before we dive in? Coming in and out. All right, how are we doing there? Is that better? Sounds good? Okay. All right, perfect. Okay, so this week's Lunch and Learn will be focused on retirement, and that's a broad subject. So like we said in the series, we have already discussed how to develop a budget, identify waste, build an emergency fund, and we learned what debt was and how to pay off high interest debt. So now we're going to cover the last steps in this session, and we'll go ahead and get started. All right, so the first topic for today is talking about employer-sponsored retirement accounts. So let's watch a short video on investing basics, on how to plan for retirement, and we'll go from there.
Retirement is something we all look forward to, a time when we can kick back and relax. We all know the goal of retirement savings, to have enough money to cover our expenses and to have a little left over for the fun stuff. What's tricky is knowing the best way to pursue those goals, like how much to save and which investments to choose. So let's go over some retirement planning basics. To plan for retirement, you need to decide 3 things: your savings goal, what type of retirement account you'd like to open, and how you'll manage the money in your account. Let's begin with your savings goal. Creating a retirement plan helps you figure out when you're going to retire and how much money you'll need to live comfortably. By identifying how big your nest egg should be, you'll be able to determine how much you need to save each month and how to allocate your investments. One quick way to come up with a retirement savings goal is by using a retirement calculator. These calculators are easy to find online and are usually free to use. By answering a few basic questions, like your age and how much you plan to save each month, you can then estimate how much money you'll have when you retire. After establishing a savings goal, your next step might be to open a retirement account. Be sure to talk with your broker, financial advisor, or tax person to discuss what kind of retirement account might be right for you. There are a number of different retirement accounts available. Let's examine some of the most common. Most retirement accounts are either employer-sponsored or individual accounts. Employer-sponsored accounts are retirement accounts offered by a company to its employees. One example of these is a 401k retirement savings plan. Employer-sponsored accounts can provide a number of benefits, including automatic paycheck withdrawal and tax benefits. Some companies even match part of its employees' contributions. One drawback to employer-sponsored accounts is that your choices for how you'd like to invest your money may be limited. If your employer offers any retirement benefits, you should examine the details to determine whether your employer is right for you. If your employer does not offer any of these benefits, or if you would like to supplement your existing retirement savings with another account that offers more investment choices, then you may want to open an individual retirement account or IRA. One of the primary benefits of an IRA is that it allows your investments to grow tax-deferred. In an IRA, you can typically invest in a wide variety of products like stocks, bonds, and mutual funds. There are several types of IRAs. Let's compare two of the most common: a Roth IRA and a traditional IRA. When choosing between the two, the primary question you need to ask yourself is, do I want to pay income tax now with a Roth IRA or later with a traditional IRA? With a Roth IRA, you pay taxes on your contributions now. However, with a traditional IRA, you are not taxed on your contributions. Instead, you pay taxes when you reach retirement age and begin withdrawing money from the account. But it's worth noting that if you also contribute to an employer-sponsored retirement account, your contributions to a traditional IRA may not be deductible. So, which tax benefits are better for your retirement savings? Well, that depends. Do you think your income tax rate is higher now, or will it be higher when you reach retirement? If you expect income tax rates to be higher when you reach retirement, a Roth IRA may be preferred. However, distinct tax implications represent just one of the differences between a Roth and a traditional IRA. Be sure to investigate all the details of each IRA account. Once you've opened a retirement account and started making contributions, the final step is deciding how you will invest your money. Your choice depends on how actively you want to manage your portfolio. Do you want to actively manage your investments yourself? Or would you prefer to leave your investing up to a financial professional? Maybe you're somewhere in the middle and want some say in how your money is invested, but don't want to have to check your portfolio every day. Check what services are available with your retirement account. Many institutions provide a variety of choices that allow you to be as active as you would like when it comes to your retirement investing. Now that you know a few basics about retirement planning, the next step is up to you. Set your goal, establish your retirement accounts, and start saving. The best time to start saving is today. Retirement is something we all look forward to, a time when we can kick back and relax.
Oh, just kidding. I was muted. Okay, so let's recap. So that was a lot of information in that video, but we learned that there are 3 essential steps that a person needs to take to plan for retirement. The first is determining a savings goal. Creating a retirement plan helps you figure out when you're going to retire and how much money you will need to live comfortably in retirement. By taking the time to build a retirement plan, you will know how much money you need to save each month to achieve retirement goals. The video mentioned a retirement calculator that you could use, and so this is the link to that just in case you want to go there after the session is over. So the second step is to see if you need to open up a retirement account, and we will discuss retirement accounts later in this presentation more in depth. And then the last step is figuring out if you want to invest your money, if you want to manage it, or would you rather have a financial advisor manage it? Or are you somewhere in the middle? So let's go ahead and start on the first step. This next video will be on how much do I need to save?
Key information to how much should I save? Deciding how much to save is an important choice that will impact your finances today and tomorrow. Looking toward the future, costs may be higher. Keep inflation in mind. A common goal is to have 80% of one's pre-retirement income for each year of retirement. Social Security and your pension monthly benefits will help you get there, but may not be enough. Now let's look at a few hypothetical situations outlining how much income one may receive from different sources in retirement. Keep in mind that everyone's situation is different. In this example, a mid-career worker who will become vested with 25 years of service and retires at 62 may need to save 6% of their salary to fill their retirement income gap after their Social Security and pension benefits. Next, an early career worker who will become vested after 30 years of service and retires at 52 needs to keep in mind that they won't be eligible for Social Security for another 10 years. Therefore, this person should consider contributing as much as possible to their account. Lastly, a late career worker who is vested with 15 years of service and retires at 65 may need to save 7% of their salary to fill their income gap after their Social Security and pension benefits. To help determine your appropriate savings amount, try Prudential's Retirement Income Calculator. It's fast and easy to use. Deciding how much to save is a personal choice. Remember, you can change your contribution rate anytime. The most important thing is to get started today.
Okay, so everyone's retirement plan will look different. It'll all depend on 3 factors. And this is what we like to call the three-legged stool approach. The three-legged stool is a metaphor for how post-World War II generation looked at planning for retirement. The 3 legs represent an employer pension, employee savings, and Social Security. And you need each one to build a strong retirement foundation. Without one, the three-legged stool would not function. So Daniel and I want to make sure that you take away from this presentation today is that you feel like you can retire comfortably. And are you on the right retirement plan right now to do that? And are you on the right track? So this next video is going to tell us the steps to see if we are on the right track for retirement.
As a member of the Total Retirement Plans, you know that part of your retirement planning journey involves taking a pulse of how your total compensation's projected retirement benefits, your supplemental savings, and Social Security all add up. To help answer this important question, the Department of State Treasurer provides you with a great tool, the MyNC Retirement Statement, or MRS. It contains valuable information that can help you make the most of your retirement planning in 5 different sections. Your personal gap analysis illustrates whether or not your retirement benefits and savings are on track to help you meet your income needs during retirement. Checkpoint 1 provides your current savings and service information. Checkpoint 2 lists the sources and amount of your projected retirement income. Checkpoint 3 shows how saving more may potentially increase your total savings for retirement. Checkpoint 4 displays the names of the beneficiaries you've chosen for both the North Carolina Pension Plan along with the supplemental plan in which you participate. Access your MRS by visiting the State Treasurer's website, myncretirement.com, and click on the Orbit login button.
All right, so what we're going to do now, at the beginning of the presentation, we asked everyone to log into their Orbit account. And if you haven't done that, you can pull it up now. I'll give everybody a couple of minutes to get to the login page and get logged in. And once you are logged in, you're going to see the blue menu bar on the left, and the main tab that we're going to focus on today is My NC Retirement Statement. So when you get there, I want you to go ahead and click that tab, and a download will start at the bottom of your screen. Once the download is done, we would like you to open up that document, and then we're going to go through each step to kind of give you an idea of what your actual information is that has been made for you individually. And the most recent document that we found is going to be based on 2019 information. So just keep that in mind as we're going through your document today. Yep, we're assuming there just might be a little bit behind. When I was going through this document, I noticed that everything was on 12/31/2019. So I just want to make sure everybody saw that because the numbers will be a little bit off. Okay, so once you click that to download, you will see at the top, it'll call Personal Gap Analysis. And the chart on the left is a visual representation of the gap or surplus in your retirement plan. They generated this number from comparing your projected monthly income to your projected monthly need. And it's going to tell you whether or not there is a surplus or a gap that needs to be filled. And are you on the right track to reach for your retirement income goal? Underneath the chart will be some options tailored to you, your individual needs, based on this gap analysis. They might say something like supplemental retirement accounts will fill the gap, or you can evaluate your current asset allocation. We will discuss these options in just a few minutes, but let's take a couple minutes to watch a video on how your monthly retirement benefits are calculated. I mean, how do they come up with these numbers?
As you near retirement, it's important to understand how your monthly benefit is calculated. This will help you make sure you are financially prepared for retirement. To understand the retirement benefit calculation, let's look at an example. Meet Jenny Smith. Jenny is 62 years old and is thinking about retiring. Jenny has worked for various state agencies for 30 years. Before we start calculating Jenny's benefit, let's quickly determine if Jenny is eligible for a full unreduced retirement or an early retirement. In order to qualify for retirement, you must have at least 5 years of membership service. You receive membership service for each month that you are actually contributing 6% of your salary to the retirement system. An unreduced service retirement means you meet all the criteria to get 100% of your benefit. Generally, you are eligible if you have 30 years of service at any age, or are 60 years old with 25 years of service, or are 65 years old with 5 years of membership service as a state employee, or 5 years of creditable service as a local government employee. To meet the 25-year or 30-year requirement, you're allowed to count all of your creditable service, which is your membership service, as well as eligible service that you purchased, service you earned in another North Carolina retirement system, and qualifying unused sick leave. Even if you don't meet the criteria for an unreduced service retirement, it is possible to retire early with a reduced benefit after you reach age 50 with at least 20 years of service, or reach age 60 with 5 years of membership service. If you retire early, your benefit will be reduced to account for the extra years you will be receiving it. Also, keep in mind that law enforcement officers have different eligibility requirements. Based on what we just learned, Jenny qualifies for an unreduced retirement since she has 30 years of service. Now, let's look at the formula that we will use to determine how much money Jenny can expect to receive each month. The annual retirement benefit amount is calculated by multiplying the average final compensation, accrual rate, and creditable years of service. Average final compensation is the average salary during your 4 highest paid years in a row. For Jenny, these past 4 years have been her highest. She made $45,000 per year for 2 years, then $49,000, and for the past year, she made $52,000. We take all 4 of these figures and divide by 4 for a total average final compensation of $47,750. The accrual rate is the percentage multiplier that's set by law. The current multiplier is 1.82% for teachers and state employees like Jenny. It is 1.85% for local government employees. The last factor is creditable years of service. Membership service, purchased service, and qualifying unused sick leave all count as forms of creditable service. Jenny has 12 months' worth of unused sick leave, so even though she worked for 30 years, her retirement calculation will be based on 31 years of service. If we multiply Jenny's average final compensation, the accrual rate, and her creditable service together, Jenny's maximum annual benefit is $26,940.55. Then we divide that by 12 to get her maximum monthly benefit of $2,245.05 each month for life. If Jenny decides that she wants to also provide a lifetime monthly benefit to someone else after her death, then her monthly benefit will be reduced to account for the fact that her benefits will continue to be paid to her survivor beneficiary upon her death. Although this doesn't apply to Jenny, some members decide to retire early. In these cases, an early retirement factor is used to determine how much their benefit will be reduced and depends on the member's age and years of service. Now that we've looked at Jenny's example, we hope you have a general understanding of how an employee's retirement benefit is calculated. Keep in mind that this is just a general overview. In North Carolina, we have some employees who work 10 months a year and others who work 12. Also, some agencies calculate sick leave in days and some in hours. There's a lot of variation, and we can't cover all those differences here. So feel free to read the member handbook for your retirement system at myncretirement.com to learn more.
All right, so let's go ahead and look at your document and let's look at the first checkpoint. So this checkpoint is your current retirement and savings. This section is going to tell you your current savings and also your years of service information. These results are as of December 2019, so just make sure you keep that in mind when you're reviewing it. The contribution section shows your balance as of the end of the year 2018, plus your 2019 contributions, along with any interest earned and any adjustments made. And then lastly, your years of service section shows you your current total service toward retirement at the end of 2019. Also, just in case you did not know, when you go into retirement, sick days, 20 sick days equals 1 month in retirement. Just in case you guys did not know that, I'll repeat it again. 20 days of sick leave when you retire equals 1 month. That's how they roll that into your retirement. I just want to make sure that we know that because every agency is different. And we just want to make sure you guys know that for CCCC employees, that is how yours will fall into. Okay, so let's move on to the next checkpoint. So checkpoint 2 lists the sources and amounts of your projected retirement income. Everyone will at least have 2 items on this sheet, and that will be the teacher and state employees retirement system and Social Security. Everything else listed will be supplemental monthly income that you have added to your retirement plan. When reviewing this, we recommend going to the Social Security website and reviewing your estimated Social Security benefit. And please note that there are 2 assumptions being made in order to estimate this for you. The first one is that you stay in your current role of employment until you retire. And the second is that your income rises with the rate of inflation. So here is a link to that website. We just recommend going there after the session is over to review that. Okay, so we'll go ahead and move on to checkpoint 3. So this chart shows how saving more in a supplemental retirement plan like an NC 401k, an NC 457, or an NC 403b could impact your savings over time. It also estimates how your actual take-home pay might be affected, and it might be less than you think. It gives you 3 separate examples of contribution percentages and shows the potential additional savings over time. So let's look at this example. If a person opens a supplemental account and contributes 2% a month based on this example, their monthly contribution will be $72 pre-taxed, and their take-home pay is lowered only by $54. This demonstrates that tax benefits of contributing to a supplemental retirement plan. This person would also earn an additional $26,000 in retirement by making this small added contribution. Please note that the chart above does assume before tax contributions and is based on your current pay and assumed tax bracket. These illustrations are just to give you an idea and they're not actual numbers. Okay, so we'll go ahead and move on to checkpoint 4. Here is where you were supposed to designate your beneficiaries on all your accounts. The payout on your NC total retirement plans, which includes your NC pension plans and all your supplemental plans, is governed by the beneficiary designator on file for each individual plan. Payouts are not based on the relationship of the beneficiary to the deceased member at the time of death. So you want to make sure that you have gone on here and filled out this information correctly. Also, we have sent you a tool, which is a worksheet that you can list all of your accounts that you have, either they're internal with estate or external, and list all of your beneficiaries to make sure that everything is up to date and that you have everything current and the way you would like it. All right, so we're going to dive into the supplemental plans offered with Prudential, and we have a video that is going to detail what these plans are, and that's where we're going to start next, and we'll go ahead.
Enrolling in the supplemental retirement plans is a great way to put yourself on the road to retirement readiness. The tools you need to enroll are at your fingertips. All it takes is 3 simple steps and online access. Step 1. Visit the plan's website at ncplans.prudential.com. Simply click on the Plan Info Enroll tab. This is the page to visit for plan information and when you're ready to enroll. For the second step, there's 2 types of information to explore. Number 1, why these plans are an important element of retirement savings and general plan information. And number 2, helpful hints guiding you through important enrollment decisions. Firstly, for important plan details, be sure to look at this table for key plan attributes. The table will be tailored to your employer once you identify your employer. More on that in a moment. Secondly, for helpful hints, please see the various videos and links to flyers that walk you through important decisions that are made during enrollment. For the third and final step, the Get Ready to Enroll section is your front door to enrollment. Select a tab in this section, depending on whether or not you work for a state agency. Then, work through the drop-down boxes so you can select the name of your employer. Important to note, now that you have moved through the drop-downs and identified your employer, the Plan Features table will tailor its information according to which plan or plans your employer offers. Feel free to take a moment to review this important information. And finally, at the very end of the drop-downs, if you don't work for a state agency, you'll be directed to an enrollment form. And if you work for a state agency, you'll be directed to enroll online. Once you select your enrollment form, you can download it and print it. When filling out your enrollment form, make sure to write legibly, and please be sure to fill in these commonly omitted fields: your email address, your full social security number, your date of hire, your daytime phone number, your contribution amount, your investment selection, and your beneficiary information. Your beneficiary elections chosen for these plans are completely separate from your pension plan beneficiary elections. Continue your journey on the road to retirement readiness by enrolling today.
What you know, savings. All right, how about now? Can you hear me?
Yes, we can hear you now.
I guess we just had a bad connection. I apologize. I just had to hop out and hop back in. Okay, let me get this presentation shared back over to you. There we go. Can you see it?
Yes, we can see it and hear you.
Great. All right. Well, we actually invited our CCCC's Prudential rep to just give us a brief overview, and also so that you could, get to speak with her. And her name is Miss Christy Kelly, and she's just going to describe very broadly the differences between the NC 401k, the 457, and the 403b.
Hey, good morning. Can everybody hear me?
Mm-hmm.
Perfect. Thank you. Well, thank you so much for the opportunity to speak for a couple of minutes. My name is Christy Kelly, and I think I've definitely met some of y'all. I can see the names on here. I've been the rep for several years with your supplemental retirement plans, and Alexandra did such a great job of talking about the pension, but I do believe there is a big misconception that this pension is going to provide enough income in retirement. I actually saw a message in the chat about that. Are you going to have enough in retirement? And the answer to that, of course, is no. On average, the pension provides you anywhere from about 43 to 48% of your pre-retirement income. So that's why these supplemental plans are so important for you to have. The state offers these plans, and your employer actually has all three of them. I think some of you are more familiar with the 401k and the 457 that's been offered for years there. And the 401k, just the name itself, I think employees tend to gravitate to the 401k, and that's what's up on the screen right now. Our website gives a good explanation of the differences there between all these plans. But the 401k is within all state and local government entities. So if you're an individual who moves around within the public sector in North Carolina, this will be anywhere you go. So I'm talking from the universities, community colleges, school systems, and even into your local government entities, your cities, counties, and towns. So it's the largest governmental 401k in the country as well. Your 457 plan, some of you may have not have heard of 457 plans because it's just within the public sector. Something really unique with the 457 too is that there are no 10% penalties when you need to start taking your money out. I think that 59 and a half age restriction really sticks in everybody's head, and of course it should, because if you withdraw funds in 401k plans before the age of 59 and a half, you would have a 10% penalty. So the 457 came about for employees, and it's not for everybody, but I give a quick example. If you started when you were 22, 23 years old, you get your 30 years of service in with the state, and you're eligible to retire. Now, there's a big difference between eligible and can afford to retire, but you're 30 years in, you could be 51, 52 years old, start receiving your pension and realize, I can't live on this. So a 457 is wonderful for those employees who may be separating from service or retiring early, because you do not have to worry about that 10% penalty. It's a great plan there to bridge the gap between when you retire, if it's at an earlier age, and then when you can get to your other plans. You may have a 401k or 403b as well, and then Social Security well into your 60s. So a nice plan there, a little more flexibility with that 457. I call it the what if plan. What if you leave early? What if you retire early? It's nice to have that in place. And then the 403b, this is fairly new to the community college, or the North Carolina 403b is. The board adopted this plan last year. And you see 403bs only in educational institutions, your school systems and community colleges. So that's where the NC 403B will be if you were to change employers or what have you. I hope you all stay with CCCC, but just to kind of let you know some of the differences there. It is not in state and local government entities at all. So one of the differences with the North Carolina 403B is that it has a different investment lineup versus the 401k and the 457. So to kind of help a little bit on that, looking at the 401k 457, the same investments. They do have GoalMaker, a tool that'll help you with your investment selection. And then 403b, a different lineup. If you're into quote unquote retail mutual funds such as your Vanguard, T. Rowe Price, that's where you could go in a 403b and have those type of investments. All three plans do have pre-tax Roth options for your contributions. They all do have the GoalMaker tool available. So with that respect, they are more similar than different. And really it comes down to a personal situation. So that's where I come into play. I can't give you specific financial advice. I help as much as possible. So if you're thinking about these three plans, I know it is overwhelming. Sometimes too many choices is harder than you would expect, but I will help you with that, see what your situation is, your age. So I think Daniel's going to actually put my virtual consultation link maybe in the notes or in an email. I'm not sure how he's going to send that out, but that's what I'm here for. Like I said, these are state sponsor benefit plans. I'm a salary employee, no commission. So these are very important plans for you to be a part of. Most important, get something started, even if it's small. Just try to increase when you can, so you will have that other nest egg along with your pension. I don't want any of you to look back and say, I wish I would have done this or wish I would have done that. Been doing this for 22 years and I still hear that every single day. So make it a priority now just to get something started, and I'm here to help all of you in any way that I can. Thank you so much.
Thank you, Christy. And yes, we are definitely going to provide your information. We have a follow-up email that's going to go out today after the session that has her virtual link so that you can schedule an appointment with Christy and discuss your options. She also mentioned a few times a tool that Prudential provides called GoalMaker, and we actually have a short informational video that we wanted to show you in case you've never come across that term before. So here's a short video that discusses what that is.
Selecting your investments within your NC 401k, NC 457, or NC 403b is an important decision. Fortunately, the plans offer a comprehensive fund lineup of top-tier investment options to help you design a well-diversified portfolio at very competitive costs. There are two approaches when choosing your investments. The first approach is to select your own investments from those offered in the plan's investment lineup. Or you can choose GoalMaker. Available at no additional cost, this easy-to-use program can help you quickly and easily select your investments. It's important to remember, each investment has some degree of risk and the potential for reward. Asset allocation can help you balance the risk and reward spectrum by spreading your money across different asset classes. If you want help choosing your investments, consider GoalMaker. In order to identify your model portfolio, GoalMaker uses two simple pieces of information: your investor style and your expected years to retirement. First, choose your investor style: aggressive, moderate, or conservative. Next, identify the time frame that most closely aligns to your years until retirement. And you're done. What makes GoalMaker a set-it-and-forget-it program? To start, your account rebalances every quarter to ensure your asset allocation doesn't drift due to market conditions. Looking ahead, your asset allocation will automatically shift to the portfolio aligned to your years to retirement, and will automatically become more conservative as you move closer to and then through retirement. For more information about selecting investments and details on specific investment options, visit ncplans.prudential.com.
All right, and one of the most important questions that you will need to be able to answer when you go to sign up for one of these plans is what type of investment style or strategy that you want to take. And oftentimes I have students who will ask me, well, how do I come to that determination? And it's actually relative to your level of risk tolerance. And so the Financial Wellness Foundation provided us this really sweet handout. And there's some more comprehensive questionnaires that you can go through, but this is a real simple one that you can fill out in your own time. And the answers to these questions can help you determine whether or not you are somebody who is a risk taker, maybe you're moderately risky, or maybe you're very conservative, like you avoid risk at all costs. And that will help you to fill out that option when you're signing up for one of these accounts, if you do decide to choose the Goal Maker option, which I think is a really great option for anyone who is concerned about retirement, but is a passive investor. And what we mean by passive is we mean you want to set it aside, but not have to check in on it daily or weekly. So if that sounds like you, then I think Goal Maker is a great option for you, but you definitely need to be able to answer this question. So please, when you have time, fill this questionnaire out that we sent you last night and see what your level of risk tolerance is. Now, in our list, we said, of course, the first thing we're going to do when we prioritize our savings, after we've lowered our high interest rate debt, is to contribute as much as we can to our retirement. The next thing is to look at other tax advantaged accounts. So I've had a lot of folks come to me and say, well, what if I've already maxed out my 401 and my IRA? Like, what if I've already contributed as much as I can to those items, but I'm still looking for other tax advantaged ways to lower my taxable income and also prepare for my future, right? So we also wanted to do a small section on a few of those accounts that are available to you in the state of North Carolina. So we're going to watch a short video that talks about 2 types of flexible spending accounts that are available to you through the NC employment system. And let's have a listen.
How much do you know about flexible spending accounts? This short video explains how these powerful benefits save you money as you care for yourself and your family. Doesn't seem possible? Watch and learn. There are 2 types of FSAs, healthcare FSAs and dependent daycare FSAs. Both allow you to set aside pre-tax dollars to pay for eligible healthcare, dependent daycare, or adult daycare expenses. Let's say your annual pay is $40,000. and you choose to contribute $2,500 during the plan year. That lowers your taxable income. And with a lower income, the IRS gets less dollars, meaning your take-home pay increases. It's basic math. You'll automatically receive your NC Flex Convenience Card through the mail when you enroll. It works just like a debit or credit card. With the HCFSA, the amount you contribute annually is loaded onto the card in full on the first of the year and will lower with each purchase you make. Eligible expenses are broken into 2 categories: those that do not require a doctor's prescription and those that do. Both groups cover just about every expense you could think of, from acupuncture to SPF 15 plus sunscreen or acid controllers to vitamins. With the DCFSA, the amount on your card is the amount you have actually contributed through payroll deductions. So it lowers when you use it and builds back up every time you make a contribution through payroll deductions. Eligible expenses include a variety of services: after-school care, summer camp, and adult daycare for both your spouse or elderly parent are just some examples. Both FSAs are use it or lose it, meaning funds you contribute do not roll over at the end of the plan year. If there's any leftover money on your account after our grace period, you'll have to forfeit it. The one exception? The HCFSA comes with a $500 rollover. That amount will deposit into your account for the next plan year, giving you some wiggle room and a leg up. For more information about filing claims, plan information, frequently asked questions, and more, visit ncflex.org.
Okay, so hopefully that gave you some really good information on a couple of accounts that are accessible to you during your open enrollment period that could really help you out with expenses that you may already have during the traditional calendar year, but maybe you weren't aware that you could figure out a way to allocate funds for those expenses tax-free. So that's one way that you could also contribute to a tax-advantaged account. The other one that we definitely wanted to highlight for anyone who has a family and has children or plans to have children in the future and wants to send them to college is the North Carolina 529 College Savings Plan. This is another tax-advantaged account where you can allocate savings that are pre-tax dollars into an account that can be used for educational expenses in the future. And those include tuition, fees, computers, textbooks, any required equipment, room and board at any eligible college or university nationwide. These funds can also be used for K through 12 tuition if say maybe you have a child that goes to an institution that requires you to pay tuition at that level. It can be used for apprenticeships and can even be used for qualified student loan payments. So it's another tax-advantaged account that comes in really handy. And you can open one up through the State Employees Credit Union. And the investments inside that account are offered either by the Vanguard or SECU. One final account that has, it's been around for a while, but a lot of folks don't know about it. And I thought, well, if we're going to mention North Carolina 529 college savings plans, then I want to make sure that everyone in this session is also aware of what is commonly referred to as the Kiddie IRA. These are actually referred to as custodial Roth IRAs. And it's a really unique concept. And I wanted to make sure that you were exposed to it because this is yet another way to have a tax-advantaged account. So let's just take a listen at what a custodial Roth IRA is.
We're here for the heavy flowers and the wedgie pickers with a pad made like no other. Up to 0 leaks because it locks blood in. Up to 0 bunching because it flexes. No worries, just always Flex Foam.
It had never occurred to me before. Parents a lot of times will open savings accounts, but what do you do with a Roth IRA for a teen?
You can open a Roth IRA for anyone, and any adult can do this, a custodial IRA. It can be a parent, it can be a grandparent, it can be a niece or nephew that you open it up for. And the only thing that has to happen is this minor has to have earned income. So as long as they're babysitting or shoveling snow, mowing lawns, they have some earned income over the course of the year, you can contribute for them up to the amount that they've earned that year, and they can contribute for themselves to that point. Wow. So the idea of teaching them how to save and invest that money, how to get a matching contribution from the adult that loves them, it's a great teachable moment for so many kids.
What actually happens with it? I mean, I can understand the benefits that come with it, but can they not touch that money until retirement, or how does the whole thing work?
Well, the benefits of the Roth IRA for a kid are just very similar to the benefits that we get as an adult.
Yeah.
Your money is growing tax-free over time, and you can make withdrawals, qualify withdrawals tax-free as well after age 59.5. If you do it beforehand, then it has to be for something like college expenses or first-time home purchase. So that has to be a qualified withdrawal. But the great thing is that your contributions to a Roth IRA, anyone's contributions to a Roth IRA, are yours to take out at any time.
What are the potential pitfalls? Those sound like a couple of them right there.
Well, so those are some of the pitfalls. I mean, you have to make sure that when your child turns 18 and the account is then in their name, that they've learned over the course of the time that they've had the Roth IRA what the value of money really is, that they're not going to drain that account and then get that 10% early withdrawal penalty and have to pay taxes on the earnings on that money. You also have to deal with, a lot of people now looking at the markets and how they're doing are like, well, is this really going to be a good investment? Well, you're looking at something over time, not something today. Think about how much money a 15-year-old who puts in $5,500 could have by the time they're 70. They could have $3 $3.4 million. If
Wait,
they
back
put
that
in
up again. If they put in how much? Let's go through
so
these numbers.
$5,500, you can put a maximum of $5,500 in a Roth IRA this year.
You do
put
that
in
every year
$5,500 every year from
for
the time
50,
you're
55 years,
Yes.
essentially, if you go from 15 to 70.
70, and you'll have $3.4 million. Now, this is also accounting for the fact that after age 50, you can do a catch-up contribution, an extra $1,000 every year.
I just want to look at that chart again.
Yeah,
I mean,
yeah.
because that's really important. People, the long runway when you're
Yes.
investing and you have decades
Yes.
for this to build up, the big difference comes in the end years. If you start this when you're 15, you have
Right.
$3.4 million. If you wait 10 years till you're 25, that gets slashed in half,
And
$1.7
slashed in
million.
half.
Because
And what about
remember
the
principle
parents?
where it doubles every 8 to 12 years or whatever may come with that.
Exactly.
That's what you have to remember.
You
The
have
big,
to remember.
Big difference comes at the end.
And I
but you
think a
gotta
lot of
start early.
parents remember that because if you are 45 and you haven't really saved enough, then your child, if they start now at 15, will have 8 times as much as you would have when they turn 70.
We can save them all from making the same mistakes we have made.
Exactly. It's a great teachable lesson. It's
I had no idea you could do it for a teenager.
And giving back to yourself is one of the great charitable lessons that you can teach your child. So then they don't have to rely on anyone else. They're financially independent, and they can help you along the way too.
Sharon, thank you.
All right, and I know we're bumping up against session time. That's probably because of the tech issues that we had. There's just a few more slides that we want to get through, so please hang in there with us. But if you do have to leave, just know the session is being recorded and we can send it to you. So the last checkpoint that was on that list that we provided to you at the beginning of this series was now I'll tell you that most folks, if you take advantage of all the resources that we've given you so far and you're focused on lowering that high interest debt and you're focused on hitting those caps for retirement and you're looking at those other tax advantaged accounts, most folks just don't have the residual income to seek after this final step. But if you do, we just wanted to touch some basics. So we're not going to go over a great deal about investing, but we did want to expose you to some simple rules for beginners investing. And we've got one more video. I think this is the last video that we have for you this week.
Investing doesn't have to be complicated. To grow a portfolio, long-term investors just need to follow 5 simple rules. Rule number 1, contribute early and often. To achieve exponential growth, you need time and regular contributions. If you were to invest $200 per week for 30 years with a 7% rate of return, you'd end up with slightly more than $1 million. But only $312,000 of that will be your own contributions. The other $700,000 would be due to compound interest. But if you can't afford to contribute $200 per week, any contribution can have an impact. And the sooner you contribute, the more time compound interest has to work its magic. Think of investing like planting trees. The best time to start was years ago. The second best time is now. Rule number 2, minimize fees and taxes. Even if fees and taxes seem like small amounts, over time they can really add up. In our earlier example, if you were paying just a 1% fee on your fund, in 30 years, you'd have $178,000 less. To limit these fees, choose funds with low expense ratios. To minimize taxes, contribute to tax-advantaged retirement accounts like a 401k or IRA before you contribute to any other accounts. Rule number 3, diversify your portfolio. Putting all your eggs in one basket is risky. Different types of investments carry different types of risk. So try to invest in a variety of asset classes, like stocks, bonds, and cash. And within those asset classes, further diversify with different kinds of stocks and bonds. Rule number 4, consider your time horizon, or how many years you have to invest. If you're saving for retirement, for example, this might be your retirement date. If you're looking for higher returns, you may need to take on greater risk. Younger investors can typically tolerate more risk because they have more time to recover. The less time you have to recover, the less risk you can take. To create a portfolio that matches your time horizon, combine different types of assets to achieve the best balance between risk and return. Rule number 5, focus on your long-term goals. The market fluctuates day to day. And if you try to time the market, you may miss out on returns. According to the National Bureau of Economic Research, if you invested $100,000 in the stock market in 2007 and didn't touch it, 11 years later, it'd be worth about $238,000. If you had sold your investment during the recession of 2008 and reinvested it a year later, you'd have $80,000 less than if you had stayed invested. Remember, contribute early and often. Limit fees and taxes. Diversify your portfolio. Consider your time horizon and focus on your long-term goals. These 5 simple rules are the most important ingredients for investing success.
All right. So just to recap, and I think she said it twice, but I'm just going to add one little step on there. So a lot of folks say, well, these are really awesome steps, and I really appreciate you giving me this information, but what's my next step? And so I always say you need to consult a financial advisor. And we actually got on this topic last week with a few folks that hung back after the session was over. And I think it's important to note that the term financial advisor is a broad term. It's a term that applies to essentially anyone that is going to give you financial advice. So, as an example, Alexandra and I are your financial advisors for this session, but that doesn't mean that we're licensed to help you invest. And so it's very important that you understand the different titles, the different licensures, and to understand which of those licensures have a fiduciary responsibility to do what's in the best interest of the investor. We simply don't have enough time to go over all of that today, but we are going to send you a list of resources that we couldn't squeeze in for today. But I don't think that we would be doing our job if we didn't at least speak about protecting your legacy, which is really the last step in retirement investing and beyond. And so just really quickly, it's very important that once you've done everything that we've told you to do and taken advantage of all these resources, and you've got a really strong plan in place, that you safeguard that plan. And typically, financial advisors will advise you to look at 3 separate areas for protecting your legacy. These are very broad areas. There's much more specific things that fall into them. The first is income protection. And income protection, when we talk about income protection, we're talking about life insurance, short-term and long-term disability, and so on. So these are financial products that can safeguard your loved ones in the event that something happens to you, whether it's an accident or an unexpected death. And that's very important to do. If you're going to make all of these moves to fortify your future, then you want to make sure that you've done something to protect them. The next thing would be to make sure that you have a last will and testament that clearly discusses the transition of your assets. And a lot of folks, when they think about assets, they think about tangible assets, real property like real estate, land, and buildings. But don't forget that your will and testament really needs to touch on every type of asset. So there's also cash, intangible assets, and what we refer to as unproductive property, things like collectibles, jewelry, automobiles, art, or any personal item of value that has a nostalgic value. Those are 4 separate areas that you would want to tend to. And then when you're creating that plan for transitioning those assets, it's also important to work with either a financial advisor, a lawyer, or someone from your bank to discuss the tax implications of transitioning those assets, because a lot of folks will develop a last will and testament, but they don't understand the tax implications of those transitions. And it's very helpful to understand what might happen once you're gone. And oftentimes I see instances where it's better for someone to gift an asset while they're still with us than leave it in a last will and testament due to tax reasons. So those are just 3 broad areas that I wanted to make sure that everyone knew about. Thank you, Morgan. I didn't even know about the Quicken Will Maker. That's pretty neat. And I do believe just a few more resources that we sent out to you to help you think about protecting your legacy. We provided you with a personal disability worksheet. This is a worksheet that you can sit down with you and your partner, if you have a partner, or by yourself, and you can fill it out and you can determine, you know, what would need to be covered month to month if you suddenly became disabled. And you know, if you have short-term disability, or maybe you have a long-term disability plan, you know, how would that supplement your income, and would you still be able to maintain the quality of life that you currently have? And we've also provided you with the personal liability worksheet, which is a little different. It's kind of similar, kind of not. In this worksheet, this helps you identify all liabilities that you might leave behind if suddenly you were no longer with us. And then it might help you determine what type of coverage you would need if for some reason, you know, you were to no longer be there to support your family. And I think that's a great worksheet to fill out before you speak to maybe someone who's selling a life insurance policy, and then determining whether or not you need maybe term life insurance or whole. Okay, and again, we really wanted to go over all of this, but an hour is just so difficult to squeeze everything in. Thank you so much to everyone who joined our series for this month. A special thanks to Christy Kelly, our retirement education counselor, for attending our last session and giving us some really great information. Alexandra has sent you all an email. It's got her contact information in it. It also has a link to schedule a virtual appointment. If you went through this series and you realized today, wow, I really need to make some moves and I need to start setting aside more for my retirement, then please take advantage of Miss Kelly. She is a terrific asset to the college. And also, maybe you have time now, maybe you might have some time this weekend. Please take a few minutes to complete our participant survey and let us know how we did. We greatly appreciate it. Also, we were sponsored by a grant to be able to offer this series, and we do need to send some evaluation responses back to them. So thanks again so much for everyone that joined us for the last 3 weeks. It's been a hoot. It's been a lot of fun. I think this is the first thing that Alex and I were able to work together on, so that was fun too. And of course, we will, as we said, we will hang back for a few minutes for anybody that has any questions. Yes, Miss Janet. Yes, Miss Janet or Miss Amy. Anybody have a question?
Hey, Daniel, I just looked at your evaluation form, and it looks like the third question, that Likert scale, it has the same scaling on either end, which is no quality value at all, no quality value at all. And I just wanted to point that out.
Okay.
Okay. Because I want to see it has
thank you so much.
quality and value.
Okay, I'll tell Alex right now, because I've got the headset, so she can't hear me. The form, the Likert scale has the same answer top and bottom, so we just need to fix that really quick.
Yeah.
She's going to work on that right now.
Thanks, Daniel, because I want to say how great this session was. I learned a lot. I really appreciate you guys, and thank you so much.
Thank you so much. Thank you. It's actually been a lot of fun to put this together.
Good. And I just appreciate your knowledge, and I'm surprised by all the things I didn't know, so this was really good.
Thank you so much. Yeah, we cover this. If anybody's looking, I know the college used to let everybody take a class for free, and I know they don't do that anymore, but we do offer so much more information in Business 125 for anybody that's just maybe interested in taking a class. And we actually have an accelerated 8-week option offered in the evenings in the fall, and we offer that through a Collaborate. So if anybody wanted to audit that class just to get more and more information on some of these topics, I would be happy to have you.
Oh, Daniel, that is really good to know and very tempting. Thank you for telling me.
Yeah.
Okay, sorry, I forgot to put on my mic. Okay, we are now on a 9-month contract, but the leave plan is calculated on 10 months. Does that make any difference?
What is the question referring to, Janet? Like, are you talking about your retirement statement, or what are we talking about?
No, you have when you go into WebAdvisor, you have W-2s, leave plan summary, stuff like that. The leave plan summary has categories for 10 months and 12 months, but we're now on 9 months.
I see what you're saying. to my knowledge, if you are a now that I might need to double check this with Carla, I don't want to speak for her, but to my knowledge, 9-month faculty only accrue time during those 9 months of service, and you have to have more than half a month to earn a month. And so I think, like, for example, in May, I do not earn a month, I'm sorry, earn a day. So for example, in May, because we don't work half of that month, we don't actually accrue sick or vacation time that day. But then in August, we come back early and we do work over half of a month in that month. So we do get a day of, or I'm sorry, I shouldn't say a day. It really depends on your years of service, right? So you get whatever your years of service say that you get, as long as you work more than half of a calendar month.
Okay, see, when we looked up that statement, it said my years of service were 21 because it was an old statement. Because I actually, this past June, I turned over 23 years. So that's still accurate, that what they're telling me, years of service, even though I've been 9 months this whole time? I mean, it's not shorter than that, is it?
Yeah, I think even when you're on a 9-month contract, your years of service still accumulate the same way.
Okay.
And in payroll, even transition 9-month faculty to where they're paid on a 12-month installment basis. So you're still paid 12 months of the year. You're just working 9 of those 12 months.
Yeah, okay. And so
And I haven't seen any changes since I changed over to, because I used to be full-time staff, and then I went to 9-month faculty, and I didn't see any changes to my years of service or how they were accumulated or anything like that.
Okay, and then for the sick leave, that you don't get paid for that, right? That just goes towards years of service. So I have 13 months sick leave. So if I wanted to retire, like in June, I would have 24 years of service plus 13 months sick leave. So that makes it over 25, right?
I see what you're saying. So I think Mike asked that question too, and Alex mentioned this earlier. So if you look at your retirement handbook, it does talk about this. So what it is when you're looking at your sick leave and you're looking at cashing it out to retire early, it takes 20 days of sick leave to account for 1 month. So they don't do it by the year; they do it by the month. But then the month is calculated using number of days. So there is a little tricky math there. But it takes 20 days of sick leave to cash out 1 month. So then I guess what would the math be on that? 20 times 12, that's 200, about 224 hours. Is that right? To get a year. So I think that's right. Is that right? Alex is doing them. Yep. Okay, I'm sorry, 240. So 240 hours is what you would need to cash a year out. So
you can
that's
cash
the rule,
it out
the rule of
instead of,
thumb.
I'm sorry, you can cash it out instead of putting it towards your years of service? I thought you could only put it towards years of service.
I'm sorry, Janet. So when I say cash out, I mean use it towards your years of service. That's what I mean.
Okay. I was going to say, wow, I mean, that's a lot of money.
I'm sorry.
But your
we
vacation
run into
you
this
get
a lot
paid for, right? You would get paid if you had 30 days vacation, which I got 43 now. But
So
yeah,
interestingly enough, you can get paid, but that's actually a good question to ask when you're nearing retirement, because you might want to look at what your income would be for that year. And you have the choice between cashing out your vacation as a paycheck and adding it, but then that might increase your income level quite a bit depending on how much vacation you have. And that could force you up into another tax bracket depending on where your salary is. This is all hypothetical, right? The other option is that you can actually roll that vacation into one of your retirement accounts. So you can to avoid taxes. So you can actually, like, if you have one of these Prudential, like a 401 or 457 or a 403, you say, well, gosh, I don't want to, to cash out my vacation. Like, what if you have, like, I don't know, what if you have 300 hours? That might be a pretty big paycheck for you, like a bonus. And then if you take it when you retire, taxes could eat away 50% of that before you see a dime. And so what some folks will do is they'll roll that money into a retirement account to avoid taxes. And then it's up to you how you withdraw it, right, in retirement.
Yeah, and I was kind of curious when I looked at my when I looked at my plan, because it says I have more money than I need. And I was trying to figure out where did they come up with the figure for the 401k? They just like threw in $300. I don't know how they came up with that.
If you're logged into your account, then it should be, it should be directly linked to your contributions to a 401k. Do you have a 401k with Prudential?
Yeah. Because I was in another place where we had 401k, so I rolled it over to CCCC's.
Okay, so maybe that's where some of it came from. Did you continue to contribute to your 401 when you came over to CCCC, or did you just roll it and stop?
Yeah, I contribute to it. A little bit at first because I was paying for my kid's health insurance, but as soon as he got off health insurance, that money that I was using, I put into contribute to the 401k.
I got you. And remember, like Alex mentioned, we're not sure what's going on at the state level. We didn't have an opportunity to reach out to someone, but the retirement statement that we looked at today is effective the 31st of December in 2019. So it's actually trailing a little bit. It's about almost 6 months behind. So if you're looking at that number and you're saying, well, I think I've got more in there, well, odds are you probably do if you've been contributing on a monthly basis.
Yeah, because I looked it up the other day and I do. But and I think I have one more question. Okay, when they figure out what your salary is, are they looking at, the 4 highest years in a row or something? Are they looking at everything or only your base salary? Because we haven't really had any raises. But, I do summer classes, and you're considered adjunct for summer. So it includes all that money? I mean, is it just basically what it shows you on your W-2?
It's everything that you earn at your parent institution. That's where it gets a little tricky, because I know there's a lot of faculty who are full-time faculty, say with CCCC, but then they might work also as adjuncts for, say, Wake Tech, Fayetteville Tech, or Durham Tech, or other colleges. So any income that you're drawing from, okay, so there you go. So any income that you're drawing at one of those institutions, that's considered a separate job. And so that does not go into that calculation of your highest incomes, like for your years of service and your retirement. But if you are overloading at CCCC, so that does count, and you should be able to see that if you log into. It's not the retirement plan part of our website. If you go to the NC employee benefits site, and I can find that link and shoot it over to you, and you log in, where you can actually see your annual contributions to the pension. It actually shows you on your little chart there. It shows you your annual income amounts that they're using for that calculation. Year over year over year. It shows every year you've contributed.
Okay, because I looked at my checks and my, my leave statements or whatever, whatever you get, your pay advice. And I did see that when I did overloads, they took out more from my retirement. The amount they're taking out from my retirement varies depending on whether or not I have overload. Because if your overload might start in August, but it doesn't actually show up until September, because they never pay for August. So I see that they are taking more out from my retirement, but I just wanted to make sure that, when they catch, because I've been killing myself and I'd like to be able to step back, but then I'm thinking I'm kind of stuck with all these overloads, because if I don't take them, then I'm going to I'm going to lower my salary. You know what I mean? Because it says the last 4 years. And it's not the 4 years, maybe the most I had made 5 years ago. I had 4 years that where I earned more money than what I'm doing now. So, okay.
Yeah, I'll make sure to send that over to you, because.
Okay. Yeah, I appreciate that. You have recorded all these sessions, but you didn't send the links out yet, right? I mean, even though I attended.
I haven't.
Yeah, so I'd like to, because you went. It's a lot,
I understand. I've been providing them to Erin Blakely, who's the coordinator of professional development, and I'm not sure where she plans to post them on the, the professional development website. But once she lets us know where they're going to be published, I will be happy to send those out. And I just want to point out, Morgan is right. It's not your last 4 years of service; it's your highest 4 years, and it's the average.
Oh, highest 4 years.
That's what I was saying.
Okay.
Yep. And it's like
But
I said,
it has
there's
to be
a
the highest.
rotation.
Okay. But it has to be the highest 4 years in a row, right?
No, it's just your highest 4 years. Like they look at all your years of service, and it's the highest 4 years. It doesn't have to be in a row.
Oh, okay. That's what I was thinking. Okay. Well, then that's good. All right. I was confused. I was thinking it was the highest 4 years in a row. But that's good. Of your
I have not
highest
heard
4
that it was
years
in
of
a row.
service.
Let me look, and I have the handbook up because I was worried that we might get some particular questions like this. Let me just make sure. I've got the handbook up right now. Let's see here.
It says the highest 4 consecutive years.
Okay, so the wording is very tricky here. It's the highest 4 consecutive years. So I guess
Okay.
the idea is that you would have to have a position with a higher income, I guess, and it would be 4 years. The expectation is that you would hold it for 4 years. Sorry, not trying to confuse anybody.
Okay. And all this stuff is in our 42-page booklet that's online. There's a 42-page booklet for retirement.
I know, and that's exactly what I'm looking at right now. I will tell you, we meant to say this earlier. Carla Parrish actually holds, I think, 1 or 2 sessions a year for folks who are about to retire, and they go over this type of information in much more detail. And I think they even practice doing a customized benefit estimate during those sessions. So I would be on the lookout. I think she normally does one at the end of each semester. I think it is. I'll have to check in with her. I think Morgan's already been to one, so he's a step ahead of me. He's already been to the session, and it's like, nah, dude, it's 4 consecutive years in a row.
Okay.
I hear
Okay.
you, man.
Well, I might take your Business 125. Is there a prereq for that? I get free course now that I'm over 65.
There's no prereq. It's actually one of the first courses our business students take.
So there's no prereq. Is that what you said?
That's right.
There is not.
No.
Okay.
No for placement testing. No nothing. You can sign up as a special credit student, which means you don't need to do anything other than just submit an application to the college so that you can be a student, and then after that you can sign up for class.
Yeah, see, I'm a senior audit, so I just have to pay for the fees or something. So everything's free, except of course I have to buy the book, and I don't even have to do any homework if I don't want to. But
right, because
I'm just trying to think of stuff to take. So, and do you offer it completely online? Business 125.
We do have a completely online option, but that one is off in the spring, not fall. The fall, we have collaborative option where you can attend virtually like we are doing right now in the evening. If you want it 100% online, where you have to live attendance, you would wait till spring to take that class.
Okay. All right. Thanks.
Karen, I'm not sure, I missed the question. What do you mean 20 rule? Okay, hold on 1 second. Okay, how's now? Is that Yep. Is it something about leaving and coming? Janet, can you turn your mic off for me?
Oh, sure. I'm sorry.
Okay, it's just there's like a feedback. Okay. Karen, are you still there? Maybe, maybe not.
Yeah, that was Mike's question. I want 50/30 for 100,000.
I don't remember us having that specific thing in the session, so I'm not sure that I'm the expert on the 20-year rule. I don't want to give you misinformation. Let me see if it's discussed. I've got the handbook pulled up really quickly.
Example, those exact words.
That doesn't, I don't think that really answers anything.
Can you go
I think what it is once you're, Alex does have some information pulled up where it says once you're the age of 50 or older and you have 20 years of credible service, you can go ahead and retire with a reduced retirement benefit. I think that's what the literature says.
In the video, it didn't say 60 years old with 25 years. That's what I wrote down.
I think age 60, you can even have as little as 5 years of service and then retire with a reduced benefit. And then when you're looking at, let me just go ahead and provide this to everyone in case I think we did send this out, but let me provide this to you folks because it gets really confusing. And I haven't actually attended one of those sessions yet that Carla does. I was actually planning on attending one, but that's the link to our handbook. And it gets really tricky when you look at pages. Here it is. It's page 14 of the handbook. There's actually a chart that shows you what the average compensation would be depending on years of service versus age. And I think age, you have to be at least 50 to be able to retire out with 20. And then it shows a few other examples. Thank you so much, Christy. We really do appreciate you coming in and chatting with us today. And I hope you get a bunch of appointments soon using that link. So I'm not sure if you, Karen, getting back to your question, I'm not sure if you got that link or not, but that's what I've been using to kind of look at my own personal situation. But again, I think some of these questions are getting a little beyond my expertise. I just don't want to speak out of turn, but I do know. And what I'll do is I'll reach out to Carla today, and I'm going to find out when her next session is on, when it comes to retirement. She goes over how to calculate your benefit, how to use page, what is it? Page 11 of that handbook, and they actually calculate, they do practice it, like they practice how to do those calculations and answer some of these more specific questions like the ones that you and Mike have. And I'll make sure that oh, you did go to it? You've been to it? Or you got the link? You're saying I did? Okay. So I'll check in with her because I bet she knows the answer to that question. I just don't want to. Okay, good. I just don't want to speak out of turn. I'd hate to give anybody misinformation. Looks like there's still 8 of us on the call. Are there any other questions?
Daniel, this is Mary Netta.
Mike, it depends. Go ahead.
I have, like, from prior state employment, an IRA that's got, very little in it. Can I put that into one of the state plans, like in the 457 or the 403?
So I know.
I just don't know.
I know that yeah, I got you. I know there's such a thing as a rollover IRA, and there's also such a thing as a rollover 401. But it's actually good that you asked that question because it allows me to touch on Mike's too. Any tax advantaged retirement account will be taxed in retirement when you pull those earnings back out, unless it has a Roth designation. And the reason why is because a Roth account was taxed before you put that money in. And a lot of financial advisors will say to you, they'll say, the best thing you can ever do is use a Roth, because what happens is you use taxed dollars to invest. Then any compound interest that you earn along the way is tax-free, which means when you pull that income back out in retirement, that you don't have to pay taxes on it at that time. Now, I don't think that's a good rule of thumb, though, because essentially you really have to look at what level of income you think you're going to have in retirement. If you allocate a bunch in retirement, you might be raising your overall taxable income. And so it's really trickier, and it really comes down to your specific situation. So that's actually a good comment, Mike. So this is how it works. So you can do a rollover, but if you try to roll over from a Roth into a standard account, you'd have to do a special consideration. There's additional paperwork. Most folks, what they'll try to do is they'll try to roll from a standard, like a standard 401 or a standard IRA, and they'll try to roll over into a Roth. Well, if you do that, you will pay a tax penalty because those were pre-tax dollars, and you're trying to get them into a tax-free retirement account. And so I think there's a penalty for trying to do that, but it is possible to do. When it comes to whether or not you can roll it over into Prudential's products, I would have to defer to Christy. I wish that she was here for your question, but we did send a link out to you guys to schedule an appointment with her. She's taking virtual appointments, so I would definitely encourage you to take advantage of that and see what she says. But if she says that you can't, then my next suggestion would be to take advantage of a Roth rollover IRA. Doesn't matter whether or not you choose the Roth or not. That's more of a personal decision for you. Very welcome. And Mike, did I answer your question? I think I did. Okay, cool. Yeah, it gets tricky. Like I'm actually running a standard IRA, but I've also got a small Roth that I'm growing. But you know, it's so tricky because you don't really know what your income is going to be in retirement, especially because, like Alex said earlier, all of these retirement calculators that are provided, they assume that you're going to hold the same position that you hold right now, and then they also use the assumption of inflation. So, you know, regardless of what your salary is, the expectation is that you're just going to stay where you are and that your salary is going to grow at approximately 2.5%, but that might not be true, right? All it takes is one promotion or change in positions, and, you know, all of those estimations can change. I'm not aware of a mandatory retirement age, but I am aware of there is a stipulation with your pension that states that if you are still working at the age of 70.5 years old, you must start withdrawing from your pension account. So I don't necessarily know if that means that you're forced into retirement or if you're forced to start drawing from your pension. So there is some information about that in your handbook that discusses that age requirement, but I don't know anything about a specific age requirement for retirement itself. So maybe that answers the question that you were really trying to answer there. Exactly, Morgan. So we could use the example that I was just saying and use it backwards and say, well, you know, the retirement calculator assumes that I've gotten a raise for the past 3 years, but I haven't. You too, Karen. Thank you. Say hi to Ronnie for me. All right. It looks like we're dwindling down. Are there any other questions? Before I stop the recording, I always try to capture the questions for anybody that might see this later. Thanks, Morgan. Thanks, Mike. You too, man. Yes, Miss Janet?
Okay, just one last question. Okay, I think there's an option when you retire that you could designate after you die some of your retirement benefits to your kids, which I don't want to do. But if I were to retire and die 2 months later, would my beneficiaries get the money that I put in, my own personal money that I put into the retirement? Would they get that?
So it depends on, are you referring to your pension or are you referring to your supplemental accounts?
I'm talking about the CCCC, what we put in, the CCCC.
Gotcha. So when we compare employer-sponsored retirement accounts, like, you know, your traditional 401ks versus a pension, that's actually one of the disadvantages of a pension, is that in the event that someone passes away earlier than expected, that there's the survivors or the heirs would not actually get the full benefit that that individual would have got. Because the way a pension works is once you start taking your benefit out, you literally receive it all the way until the day you die. And it doesn't matter if you live 5 more years, 10 more years, 20, 30, 40 more years, you're going to get that benefit. Now on pages, I think it's 17, page 17 of your handbook that I sent out, that link, it goes over each one of those options that you're referring to, and it discusses the details of, because there's several options actually that you can choose, and you have to make that choice before you retire, because once you make your decision, you're stuck with it.
Okay, I mean, I already know that I don't want any of my my kids to get any part of my pension while I'm drawing it. But I was just wondering,
Gotcha.
say, like, over the years, they actually took out money of your salary, say $300 a month. So that was your money, do you get, and if you die quick, is any of the money that you actually put into it, not that they put into it, but that you actually put into it, did they get any of that?
No. So during your first 5 years, you're setting aside that money so that you can become vested. But once you become vested, you are a part of the state pension plan, and that's how a pension works. A pension, when I teach this to my students, the best example that I normally provide to help students understand the difference between a pension and a 401 is a pension is really not all that different from Social Security. You are essentially paying for someone else's, so you're like the allocations, the contributions that you're making beyond your 5th year, well, up to your 5th year too, but once you become vested, the contributions that you're making are going into a large fund. That fund is being managed by what we call an actuary, which is probably like a chief financial officer or a treasurer. And that individual is managing that fund to generate a revenue stream that can not only pay for your retirement when you get there, but is also paying for people who are currently in retirement. So it's very similar. It's a similar concept to Social Security.
Okay,
so,
that makes
once you are,
go ahead,
So
that makes it clear
that
to
helps
me.
you
I didn't
understand it a
know
little
it
bit
worked like
better.
that. I
So
didn't know
then
it
the
worked like Social
supplemental
Security.
accounts, and so you have those options on how if you were to pass away sooner than expected, there are options on page 17 of your handbook for how someone else would receive your benefit from your pension. If you were no longer here, there are a few different options that you can choose from. Now, that does not apply to any supplemental accounts that you open with Prudential. You own that money. That's your money. That's your pot. And if you were suddenly to pass away and not use all of it, you could then leave that in an inheritance, in a last will and testament. You could leave those accounts. Those are referred to as intangible assets, and that is something that you would definitely want to list when you're discussing transition of assets, when you work with someone to develop that plan.
That's the one where I called and I have like my son with autism has to have a trust, and I'm still trying to figure out. They sent me the paperwork, but I don't understand the paperwork, so I'm gonna have to call them up again. Because this trust is not in any kind of a bank. It says it was created with my last will and testament, so it doesn't actually exist yet. Because I have to die, I think, before the trust actually gets created.
But there should be someone who is named as the executor of your estate, and that's the individual that would handle all of that when you're no longer here.
Yeah, he's they
would actually make sure that all.
Yes,
exactly. So,
but
that's definitely something that you want to discuss.
Yeah. Okay. I got a lot of work to do. That's that reason I haven't even done anything yet, because it's just I haven't had time. But I didn't know see, I'll be 70 in August, and I hadn't planned to retire before next June. So you're telling me that I'm going to have to start taking money out of both of them, of the 401k and my retirement from CCCC?
Not your 401, but now this is just according to the handbook, because I'm definitely not the expert on the retirement benefits, but according to the handbook, when you reach the age of 70 and a half, you must start taking out your benefits. So I don't know if that means that you're forced into retirement. I don't want to speak for anyone because I'm really not sure what that means, but that is what the handbook states.
Okay, well, I guess I might be retiring earlier than I expected. Okay, well, I better give Ty a heads up.
I definitely think that you would want to reach out to Carla. I think the best thing that you could do would be to reach out to Carla and see if you can just have a short chat with her over the phone, maybe.
Yeah.
Because she could probably answer those questions better than me.
Okay. Well, I appreciate everything. I know I've been a pest, but I mean, I just have a whole lot
you're not
to
a
learn.
pest. You're not a pest.
Yeah.
You're just curious. You're just curious. That's all it is. That's why we did this.
Yeah, well, I really needed it. And I had done something similar to this, but it was a long time ago when I wasn't near retirement. So some of the stuff I knew about the emergency fund and all this kind of mess, but all this. So I'm really glad you spent this last session on the retirement because I really need that. So, okay, well, I'll let you go because you're probably getting hungry. Okay, so, and I'll look forward to the, to the recording so I can go over this again and again. Okay, thanks.
Okay. Thank you,
Bye.
Janet. Have a great weekend. Bye-bye.
Thank you too. Bye.